Hey everyone, it's Ola Nkalamidi and welcome back to my channel, FinCorrect. We'll dive into the world of project finance again to take a closer look at debt modeling in project finance. Debt modeling plays a critical role in evaluating the feasibility and sustainability of any project. So, by stimulating various debt structures and repayment scenarios, we can assess a project's ability to meet its financial obligation. Every project has its own unique features and requirements and has to be designed such that the optimal debt structure aligns with the project risk profile and financial objectives. There are different types of debts in project finance. The first tier is the senior debt. This type of debt takes top priority in repayment. It has lower interest rate and has the highest claim on the borrower's assets. The second is the mezzanine debt. It is an hybrid loan that sits between senior debt and equity. Mezzanine debt carries higher interest rates and may even offer equity options. The bridge loan. The bridge loan offers short-term financing until permanent funding is secured. Revolving credit, which happens to be the last year, this facility grants borrowers access to funds up to a set limit, so the borrower can borrow and pay off his obligation repeatedly. Now, let's explore the key features of debt in project finance. The principal amount. It is the initial amount that was borrowed. Tenor. This is the duration that the borrower is expected to repay his obligation, including the principal and interest. Maturity date. This is the deadline date for full repayment. Collateral. Collateral is the asset that has to be pledged as a security for the loan. Moratorium. Moratorium is like the grace period, right? The borrower is not expected to make any payment of principal in this period, and sometimes he may also not be expected to make payment of interest. Borrowing cost. Borrowing cost is the interest rate and fees. For this, we have things like interest rate, arrangement fees, commitment fees, and what have you. Repayment terms. This provides the schedule and method for repayment, which can vary based on the choosing repayment type. Speaking of the repayment, let's look at different repayment structures. Annuity repayment. Annuity repayment provides equal payment of debt service, covering both principal and interest over the repayment period. We also have the sculpted. Here, repayment is tailored to match the project's cash flow pattern. The bullet. The bullet here simply means the initial amount that was borrowed is paid back at maturity, though periodic interest payment is made during the loan period. The linear and phased repayment type. This repayment type, what we have here is that equal principal repayment is made at regular interval, while debt service varies and reduced towards the loan period. The debt service is a term used to express both interest and principal repayment, and a debt service reserve account, which is DSRA, is used to make debt repayments when the cash flow available to service debt is too low. Now, let's shift our focus to appraisal metrics used in project finance. We have the debt service coverage ratio, which is DSCR. This evaluates the project's ability to cover its obligation from operating cash flow. We also have the loan life coverage ratio, which is LLCR. This is similar to DSCR, but it's considered debt coverage over the entire loan term. We have the project life coverage ratio, which is PLCR. It assesses debt coverage over the project's entire lifespan. We have the debt to equity ratio as well. It indicates the proportion of debt financing relative to equity. To round up, debt modeling is an essential tool for lenders and investors in evaluating a project viability and level of risk, which can help in making informed decisions in project finance. In our coming classes, I'll guide you through the practical steps of debt modeling in project finance. So thank you for joining us today, and don't forget to like and subscribe.